All right, today we're going to jump into a core accounting concept that is absolutely essential if you want to understand the true financial story of a business. It's called the accrual principle, and trust me, it helps us see way beyond just the cash sitting in a bank account to what's really going on under the hood.
So, let me start with a question for you. When you look at your company's bank balance, do you think you're seeing the full picture? I mean, it feels like the most direct measure of success, right? Cash is king. But what if I told you that cash on hand can actually be, well, pretty misleading sometimes? And this brings us to two totally different ways of thinking about financial storytelling. On one side, you've got cash accounting. It's simple, it's direct, it just follows the money as it zips in and out of your account. But on the other side, you have accrual accounting, which is all about capturing the economic reality of what a business is doing. And that, my friends, is a much more powerful story. Really, the whole difference just boils down to one simple thing: focusing on what happened versus when the cash actually moved. And getting your head around that philosophy is the key to unlocking everything else we're going to talk about.
So here it is, the big one, the accrual principle. The rule is actually pretty simple. You recognize revenue the second it's earned, not when you get the check. And you record an expense the moment it's incurred, not when you pay the bill. It doesn't matter when the cash shows up to the party. What matters is when the economic event actually happened.
And you might be asking, what's the engine that makes all this work? Well, it's something called the matching principle. Think about it like this. To get a true idea of how profitable you were in, say, December, you have to take all the revenue you earned that month and match it up against all the costs it took to get that revenue in that same month. It's the only way to get a truly honest look at your performance.
Okay, so that's the theory, but let's see how this thing actually works in the wild. We're going to make this super tangible with a couple of real-world examples. Think of it as a tale of two different financial timelines. Okay, so imagine you're a consultant, you hustle all through December, and you finish this big project worth $5,000. Awesome! You fire off the invoice on December 30th, but your client, well, they don't actually pay you until January 15th. So here's the question: how much revenue did you really make in December? If you're using the cash method, the answer for December is a big round zero. Kind of depressing, isn't it? From this point of view, since no money actually landed in your bank account, you technically earned nothing from all that hard work in December. But switch over to the accrual method and voila! You record $5,000 in revenue for December. And this right here is the aha moment. You did the work, you earned that money in December, and under the accrual principle, that's what matters. That revenue belongs to the period when you did the work, period. Now, let's flip this around and look at an expense. Let's say your office rent is $2,000 a month, but, with the holidays and everything, you don't actually get around to paying December's rent until January 2nd. So what was your rent expense for December? Well, under the cash method, since no money for rent left your account, your books show a $0 expense for December. This makes December look artificially fantastic, super profitable, but it also sets up January to look artificially expensive. The whole picture is just wonky. It's completely distorted. The accrual method, on the other hand, comes in and fixes that distortion. It records a $2,000 rent expense in December because you used the office. You got the benefit of that space in December. The expense is matched to the period it belongs to, which gives you a true and fair view of your costs. So how do accountants actually keep track of all these timing differences? It's not magic. They have a very specific toolkit for the job. Let's take a quick peek at the key accounts that make this whole accrual system tick. Let's connect this right back to our examples. That $5,000 you earned but haven't gotten yet, that goes into accounts receivable. It's basically the company's IOU list from its customers. That $2,000 in rent you haven't paid, that's accounts payable, your IOU list to your suppliers. You also have accrued expenses for things like employee salaries they earned this month but won't get paid till next, and deferred revenue, which is when a client pays you upfront for a job you haven't even started. Each of these tools helps paint the true economic picture. Okay, so we've covered the what and the how, but let's finish up by talking about the payoff. Why go through all this extra complexity? Why does the accrual principle actually matter so much in the real world? It really all comes down to three huge benefits. First, it gives you way more accuracy. It smooths out those crazy peaks and valleys of cash flow to show you how the business is really performing over time. Second is compliance. Standards like GAAP pretty much require it for most companies, so it's not really optional. And third, and this might be the most important, is investor insight.
Investors don't just want to see your bank balance. They want to see what you've earned so they can understand your true performance and try to predict your future. All right, for our final showdown, let's put everything side by side one last time. This summary comparison should really help lock in these ideas for good. So let's break it down real quick. Timing. Cash is all about when money moves. Accrual is about when the transaction happens. Complexity? Yeah, cash is simple, it's easy. Accrual is definitely more involved. But the real payoff is the insight. Cash shows you your immediate liquidity, what you can spend today. Accrual shows you your long-term profitability and your actual financial health. And that's why it's the gold standard for pretty much every major corporation out there.
So, if you take one thing away from all of this, let it be this thought. Profit isn't just what's in your wallet, it's about what you've truly earned. The accrual principle is the tool that lets us see that critical difference, the difference between just having cash and actually building a healthy, profitable business.